Hedging equity and non-repriceable liabilities. Key techniques for effective risk management. Agenda items. Understanding hedging and its importance. Equity hedging techniques. Hedging non-repriceable liabilities. Developing a hedging strategy. Regulatory and reporting considerations. Definition and purpose of hedging. Risk mitigation. Hedging is primarily focused on mitigating the risk of adverse price movements in financial markets. Reducing potential losses. The main purpose of hedging is to reduce potential losses from market volatility while maintaining the opportunity for gains. Opportunity for gains. While hedging protects against losses, it also allows investors to benefit from favorable price movements when possible. Types of risks managed by hedging. Market risk. Market risk involves potential losses due to fluctuations in market prices. Hedging helps to stabilize returns by managing this risk. Credit risk. Credit risk arises when a borrower fails to meet obligations. Hedging strategies can mitigate potential losses from defaults. Interest rate risk. Interest rate risk affects the value of financial assets due to changes in interest rates. Hedging can protect against these fluctuations. Currency risk. Currency risk involves the potential for loss due to exchange rate fluctuations. Effective hedging can safeguard against this uncertainty. Benefits of effective hedging strategies. Improved financial stability. Effective hedging strategies contribute to enhanced financial stability for companies by minimizing risks associated with market fluctuations. Reduced earnings volatility. By implementing hedging strategies, companies can reduce earnings volatility, leading to more predictable financial performance. Enhanced investor confidence. Effective hedging instills greater confidence among investors, encouraging them to support companies and invest for growth. Focus on growth. With risks mitigated, companies can concentrate their efforts on growth and innovation rather than worrying about potential losses. Basic equity hedging instruments. Options, futures. Options overview. Options are flexible financial instruments that allow investors to hedge against potential market declines effectively. Futures overview. Futures contracts provide certainty in pricing, allowing investors to lock in prices for future transactions. Hedging against market declines. Both options and futures are used to hedge against market declines, protecting investments from losses. Advanced equity hedging strategies. Collars, spreads. Understanding collars. Collars are hedging strategies that combine options to establish a protective price range for an asset, minimizing potential losses. Benefits of spreads. Spreads involve the simultaneous buying and selling of options to limit risk exposure while maintaining potential for profit. Hedging techniques. Advanced hedging techniques like collars and spreads are essential for managing risk in volatile markets. Characteristics of non-repriceable liabilities. Fixed terms and rates. Non-repriceable liabilities have fixed terms and interest rates, limiting flexibility in response to market changes. Inflexibility in management. These liabilities' inflexibility requires adopting specific strategies for effective risk management to mitigate potential financial impacts. Common hedging instruments for non-repriceable liabilities. Interest rate swaps. Interest rate swaps are agreements between parties to exchange interest payments, which help manage fixed rate liabilities against fluctuating rates. Interest rate caps. Interest rate caps provide a ceiling on interest payments, protecting borrowers from rising rates, which is essential for managing fixed rate obligations. Risk mitigation strategies. Using interest rate swaps and caps are effective strategies to mitigate risks associated with non-repriceable liabilities in volatile interest rate environments. Challenges in hedging non-repriceable liabilities. Inflexibility of liabilities. Non-repriceable liabilities are characterized by their rigid nature, making it difficult to adjust them in response to changing market conditions. Market conditions impact. Conditions can significantly influence the effectiveness of hedging strategies, complicating the management of non-repriceable liabilities. Strategic development. To effectively hedge non-repriceable liabilities, it is essential to understand and develop strategies that account for their unique challenges. Assessment of risk exposure. Importance of risk identification. Identifying risk exposure is crucial as it lays the foundation for developing effective risk management strategies. Assessing risk exposure. A thorough assessment of risk exposure enables better decision making regarding hedging instruments and tactics. Developing hedging strategies. Insights gained from risk exposure assessment are vital for formulating effective hedging strategies and ensuring financial stability. Selection of hedging instruments. Importance of hedging. Selecting appropriate hedging instruments is essential for managing financial risks and ensuring business success. Types of risks. Consider the specific types of risks being faced, such as currency fluctuations, interest rates, or commodity prices. Market conditions. Understanding current market conditions is vital for selecting the right hedging instruments and strategies. Organizational needs. Evaluate the specific needs of the organization to ensure that the hedging instruments align with business objectives. Monitoring and adjusting the hedging strategy. Importance of monitoring. Continuous monitoring of the hedging strategy is crucial to adapt to market fluctuations and ensure its effectiveness. Adjusting the strategy. Adjustments to the hedging strategy may be necessary to optimize performance and mitigate potential risks. Reducing risks. Optimizing the hedging strategy not only enhances performance but also plays a vital role in reducing financial risks. Regulatory and reporting considerations. Jurisdictional variations. Regulatory requirements for hedging differ across jurisdictions, necessitating tailored compliance strategies for organizations. Reporting standards. Organizations must adhere to specific reporting standards related to hedging to maintain transparency and compliance. Ensuring compliance. Understanding regulatory requirements is crucial for organizations to avoid penalties and ensure lawful operations in their hedging activities. Financial reporting implications. Impact of hedging on reporting. Hedging activities significantly influence financial reporting by altering the recognition of gains and losses. Importance of understanding implications. A clear understanding of hedging implications is crucial for producing accurate financial statements. Compliance best practices. Risk mitigation. Implementing compliance best practices is crucial for mitigating risks in hedging activities, safeguarding the organization. Regular training. Conducting regular training ensures that employees are aware of compliance requirements and best practices, leading to better adherence. Audits and updates. Regular audits and updates on regulations are essential for maintaining compliance and adapting to any changes in laws. Conclusion. Importance of hedging. Hedging equity and non-repriceable liabilities is crucial for effective financial management and risk reduction. Strategies and techniques. Understanding various strategies and techniques is key to enhancing risk management practices in organizations. Regulatory considerations. Awareness of regulatory considerations is essential for compliance and effective risk management in finance. Thank you.